Welcome to the deep dive. You've handed us a really fascinating collection this time,
Hmm.
all centered around business analysis and, investing. We're looking at excerpts on checklists, informed investing principles, value investing,
Mm.
quite a stack.
Exactly. And I think our goal here for this deep dive is to really go beyond just like broad concepts.
Right.
We want to pull out the most important insights from these sources,
Mm,
give you practical, actionable things for evaluating businesses, especially if you're thinking about investing.
like a shortcut almost to the key questions.
Yeah, think of it like that, your personal cheat sheet for figuring out what really matters in a company's value.
Okay. So we're not just repeating information. We want to surface the essential questions, the areas you really have to dig into, a roadmap for analysis.
That's the plan.
Great. So with all this material, where's the most logical place to start?
Well, given your sources, a really natural first step is just thinking about how you even find potential investment ideas to begin with. The informed investor actually offers several interesting starting points for that.
All right, let's unpack that. Where do these ideas, these initial sparks, tend to come from?
Well, the book points out some pretty intuitive places, actually. One is just your own life as a consumer.
Ah,
Like, have you noticed a product or service that really impresses you or solves a problem really well?
yeah.
That personal experience can be a pretty powerful signal.
Makes sense. And what else?
Then there's watching successful investors. What are they buying?
Yeah.
But maybe more importantly, why are they buying it? What's their reasoning?
Learning from the best, basically. See where the smart money is going and try to figure out their thinking.
Exactly. And the sources also mention looking at new low lists.
New low list. So companies whose stock price has dropped.
Yeah, fall into maybe a 52-week low or something. The idea is that sometimes good businesses get dragged down by, you know, market noise or temporary issues. Could be an opportunity.
Okay, interesting. What else?
Staying up to date with industry publications, trade journals. That gives you a really deep, granular view of specific sectors and who the main players are.
Right. Keeping your finger on the pulse of different industries. Are there more sort of specialized situations mentioned?
Yep, things like IPOs, initial public offerings, when a private company goes public.
Always exciting, but maybe riskier, less history.
Definitely less history to analyze, yeah.
Yeah.
Then there are spin-offs. A larger company carves out a division into a separate independent business. That new focus can unlock value.
Okay.
And even bankruptcies. Companies that have gone through restructuring, though that's definitely a more complex area, requires real expertise in distressed situations.
Wow. Okay. That's quite a range from everyday stuff to really niche situations.
Mhm.
Is there a more like proactive technique suggested? Something a bit different?
There is actually. The informed investor talks about a really practical, kind of intriguing idea.
Oh, yeah. What's that?
Taking a small initial stake, just buying a few shares of a company that catches your eye.
Huh. Just a few shares, so not a big commitment.
Exactly. But the psychology is interesting. Once you own even a tiny piece, you're way more likely to actually follow it. Read the reports, pay attention to the
It
news.
forces you to engage, basically.
Precisely. It's a low-stakes way to move a company from just interesting to actively monitoring. Paul Sonkin from the Hummingbird Value Fund apparently has this grab bag approach.
Yeah.
Owns single shares in hundreds of companies just to stay connected.
That's fascinating, like building a super broad, cheap watch list. But I assume the sources stress this is just the start, right?
Oh, absolutely critical. Generating the idea. That's step one of like 10.
Okay.
Your sources are really clear. Wherever the idea comes from your experience, a list, whatever it must be, followed by deep, rigorous research and valuation before you commit serious money.
Research and valuations, the non-negotiables. Okay, so you've got an idea. What's the next layer? Where do we dig next, according to these materials?
Well, moving past just finding the company, the investment checklist really pushes you towards understanding the business from the ground up. And that means understanding its customers.
The customer. Right, seems obvious, maybe, but how deep do we need to go?
Very deep, apparently.
Mhm.
The checklist asks some key questions. Like, first off, who is the core customer?
Okay.
They use the Whole Foods example, which is pretty telling. They found something like 25% of their customers accounted for 75% of their sales.
Wow, that's a huge concentration, like the Pareto principle in action.
Exactly. So knowing who your most valuable customers are, what makes them tick, that's vital. And the flip side, too.
The flip side.
How diverse is the customer base overall? Or is it super concentrated? Think about, say, an auto parts supplier.
Right, they might only sell to a few big car companies.
Precisely. Lose one or two of those big contracts, and it's potentially disastrous. So a diverse base generally means less risk, more stability.
Makes perfect sense. You don't want to be too reliant on just a couple of big accounts. What other customer stuff is key?
Customer retention rate, absolutely crucial. How long do customers stick around?
Because it costs more to get a new one than keep an old one.
Almost always, yeah.
Yeah.
Way more expensive. Plus, loyal customers. They provide predictable revenue, and they often become your best marketing tool through word of mouth.
The best kind of marketing. Do the sources give examples of companies that really nail this customer focus?
They do. Costco gets mentioned for its policy on limiting markups. Even when their own costs go down, they pass savings on. Builds huge loyalty.
Yeah, people love Costco for that.
And Southwest Airlines with their free check bags policy. That definitely stood out against competitors charging for everything.
So tangible actions, not just talk. How can we as investors figure out if management genuinely cares about the customer?
Well, the checklist suggests looking for evidence of how management stays connected. There's an anecdote about Howard Lester, the former Williams-Sonoma CEO.
What did he do?
Apparently, he personally read every single customer letter and comment card.
Every single one.
Oh, wow. Yeah. That level of direct feedback is pretty invaluable, right? Shows real dedication.
Definitely signals they're listening. What about this idea of, like, what if the business just vanished?
That's another great question from the checklist. If the company disappeared tomorrow, how much would customers actually miss it?
Would they just switch easily, or would it be a major pain?
Exactly. The more indispensable you are, the stronger your position,
Yeah.
the stickier your revenue.
It gets to the core value proposition, doesn't it? What pain point are they solving?
Precisely. And how much do customers depend on them? Is it a nice-to-have or a must-have? Gauges the real underlying demand.
Got it. Not just how many customers, but the depth of that relationship. Okay, next up, competitive advantage and the industry landscape. This feels really central.
You got it. Super critical area. The investment checklist really emphasizes finding a sustainable competitive advantage.
Sustainable, meaning it lasts.
Yeah, something unique that keeps rivals at bay and lets the business earn better profits over the long haul. Without that moat, as Buffett calls it, competition just chips away at profits.
Okay, so what kinds of things create these moats? What are the sources?
The checklist outlines a few key types. Strong brands are one, Four Seasons, Nordstrom, maybe Starbucks. People trust them, pay a premium.
Right, loyalty.
Network effects are another. Where the service gets better, the more people use it. Facebook is the classic example. Or even something like a timeshare network. Hard for a newcomer to compete.
Because the existing network is too valuable. Makes sense.
Then you've got patents. Legal protection. Think drugs like Lipitor for Pfizer or Qualcomm's tech. Gives them exclusivity for a while.
A legal moat.
Cost advantages, too. Maybe they have huge scale or a secret process or a great location. Lets them operate cheaper than competitors.
Undercutting rivals, but still making money.
Exactly. And finally, customer captivity or high switching costs, like Blackboard in education software. It's such a hassle for a university to switch systems, they tend to stick with it.
They're kind of locked in. Okay, those make sense. But the material warns these advantages aren't forever, right?
Absolutely not. Moats can shrink. Technology changes, new business models emerge. Look at Blockbuster versus Netflix. That advantage can erode or vanish completely.
So you have to keep checking if the moat is still strong. What about the industry itself? How important is the neighborhood the business lives in?
Oh, hugely important. Some industries are just structurally more profitable than others. Think about the competitive intensity, the power of suppliers, the power of customers.
Like Porter's Five Forces.
Basically, yeah.
Sure.
Even a great company can struggle in a really tough industry. The checklist mentions using things like S&P industry surveys to get a handle on the sector dynamics.
Do your homework on the industry's health. What about when competition gets weird? Like irrational?
Yeah, that can happen. And it can actually create opportunities sometimes.
How so?
Well, the Blockbuster example, again, they tried to match Netflix on price for mail-order DVDs, right?
Yeah.
But their whole cost structure with stores made that totally unsustainable.
They were acting irrationally out of desperation.
Pretty much. So if you can spot situations where competitors are making strategically unsound moves, maybe the more rational player is a good bet. You need to understand the why behind competitor actions.
See through the noise to the economics. Okay. And how do you figure out what's normal for an industry, performance-wise?
The checklist suggests benchmarking. Compare key financial metrics across competitors.
Like profit margins, returns on capital.
Exactly. Gross margins, operating margins, ROIC, cash conversion cycle. Compare your company to its peers, especially the best ones. It gives you context, shows relative strengths and weaknesses.
In benchmarking, fundamental stuff.
Yeah.
Okay, customer, moat, industry. Now, pricing power. This sounds like a really good thing to have.
Oh, it absolutely is. The checklist defines it pretty simply. Can the business raise prices without losing a ton of customers?
That implies they have something special, right?
Right.
Strong brand, unique product.
Exactly. Some kind of differentiation. The text mentions Haagen-Dazs ice cream, commands a premium price, or Compass Minerals, a big salt producer. Salt is essential, and they have regional advantages. Customers are less sensitive to price.
Not just competing on price alone. So how do we as investors figure out if a company actually has this power?
Look for evidence. Are they actually announcing price increases? Check earnings calls, reports.
Okay.
Then try to figure out if those increases are sticking. Are customers paying up, or are they switching to cheaper options? Management commentary, industry news, even customer reviews can give clues.
So they raise prices and people still buy.
And critically, does it actually flow to the bottom line? Are operating margins improving because of the price hikes, or are they just keeping up with rising costs?
That's key. It has to boost profitability, not just offset inflation.
Right. Compare margin trends over time. And if a company isn't talking about price increases or premium positioning, probably a sign they don't have much pricing power.
Makes sense. If you've got it, you usually mention it. Okay. Pricing power, very attractive. Now, let's pivot to something maybe trickier. Management quality. This feels subjective.
It definitely is nuanced, but it's so critical. The checklist hammers this home. Leadership drives everything long-term. It even suggests thinking about different types of managers, like owner-operators or long-tenured execs.
Owner-operators, people with skin in the game, their own money's tied up. That seems good, right?
Generally, yes. Strong alignment with shareholders. But the text adds a layer. What kind of owner-operator? Are they focused on all stakeholders, customers, employees, community, or more on personal gain? Leslie Wexner at Limited Brands is mentioned as someone with high pay alongside big ownership.
So ownership alone isn't the whole story. What about the long-tenured types, people who came up through the ranks?
A big advantage. They usually know the company inside out. Culture, operations, history. Deep understanding.
What's the downside?
Well, maybe someone who is great at, say, operations isn't necessarily the best strategic thinker for the CEO role. The text mentions Kevin Rollins taking over from Michael Dell at Dell. Seemed logical, but didn't quite work out as hoped.
Past success isn't always predictive at the next level. The checklist also has that memorable metaphor, the hyena and the lion, for character.
Yeah, that's from Sing Hak Tan. The lion manager respects everyone, top to bottom, treats people with dignity.
Okay.
The hyena might be more dismissive, or only nice to powerful people. It's a subtle thing, but it can reveal a lot about their values and the kind of culture they build.
How they treat people matters. What about digging deeper into their background than just the official bio and the proxy statement?
Absolutely essential, the checklist says. Go beyond the titles. The example of Larry Young at Pepsi is good. Started as a route salesman, worked his way up. That tells you way more about his understanding of the business than just former division president.
See the whole journey.
Yeah, and look at their experience with the customer base. Jack Stahl moving from Coke to Revlon, different customers, different challenges. That's specific industry knowledge is often key.
Right. Relevant experience. Now, CEO pay. Always controversial. How do you judge if it's aligned with shareholder interests?
That's a big one. The text contrasts examples. Dave Gold at 99¢ only. Joe Mansueto at Morningstar. Fairly modest cash pay, huge equity stakes, amazing long-term returns.
Okay.
Then Robert Nardelli at Home Depot, massive pay package. Stock went nowhere. The key is looking for clear alignment between pay and long-term value creation, like Markel Insurance, focusing on growth and book value per share.
Incentives matter. What about insider buying? Management buying their own stock. Good sign.
Usually seen as positive, yeah, a vote of confidence. But context matters. How big is the purchase relative to their total wealth?
A tiny buy from a billionaire might not mean much.
Right. Compared to a manager putting a significant chunk of their net worth into the stock. The checklist mentions Carl Kirkland at Kirkland's, Jamie Dimon at Bank One, making big, meaningful purchases. Those send a stronger signal.
Size and significance relative to the individual.
Yeah.
Go. Beyond ownership and pay, just basic competence. Track record.
Paramount. Have they successfully navigated different cycles, different challenges over time? Past behavior is often the best predictor.
Makes sense.
And the checklist also distinguishes between managing purely for profit versus a broader stakeholder view. Think Costco keeping prices low, M&T Bank's community focus, the old HP way. Often, prioritizing customers and employees leads to better long-term shareholder returns anyway.
A more sustainable approach. What about strategy? Are rigid 5-year plans the way to go?
Interestingly, the sources suggest maybe not. Often the best companies adapt through lots of smaller, customer-focused decisions, incremental improvements.
Like Apple's early focus versus, say, Motorola's huge Iridium bet.
Exactly. Apple-focused, adapted. Iridium was this massive, rigid plan that failed. Flexibility and customer focus often beat a grand, fixed strategy.
Agility matters. What about structure? Centralized control versus decentralized.
Decentralized is often favored in the sources. Pushing decisions down, empowering employees, can lead to faster responses, more innovation, lower overhead. Berkshire Hathaway's model, Penn National Gaming, letting property managers decide.
Versus top-down bureaucracy.
Yeah. Centralized can be slower, less engaging for staff. Sometimes looking at CEO pay relative to other top execs can hint at how centralized it is.
Interesting. And company culture, shared values.
Hugely important for long-term success, the sources say. Strong, clear culture based on shared values guides behavior, and managers have to live those values.
Off the talk.
Right. And fostering candor is key. Employees feeling safe to speak up, challenge things, like Motorola under Robert Galvin. A good culture is a real asset. A toxic one, like Health South was described, is a massive red flag.
Culture as a competitive advantage or disadvantage. Okay, last point on management. Capital allocation. This sounds critical. How do they spend the company's money?
Super critical. Look at their past decisions. Where did the excess cash go? Were they disciplined? Like Penn National's CEO waiting patiently for the right hotel deal.
Instead of rushing into something mediocre.
Exactly. Are stock buybacks smart and timely, like AutoZones were cited? Or are acquisitions strategic fits bought at good prices? Or just empire building?
Avoid managers who just want a bigger company regardless of return.
Right. And watch out for constant share issuance that dilutes everyone. You want managers who, as Buffett says, love the business, not just the money or the perks. Look for integrity, independent thinking, not just following the crowd or hyping the stock like Bernard Ebbers at WorldCom.
A really deep look at the people in charge. Okay. We've covered a ton on management. Let's shift to growth opportunities. Everyone wants growth, but how do you know if it's good growth? Sustainable, profitable.
Yeah, that's the key question, isn't it? First, the checklist says, look back. Was the historical growth actually profitable? Western Union is the example. Transaction volume grew, but profit per transaction fell. That changes the story.
Not just top-line growth.
Right. Then look forward. Read the 10K's management discussion. Understand the big secular trends, like more women working driving demand for convenience. Are there tailwinds helping the company?
Track record plus future potential based on big trends. What about R&D, innovation?
Often vital for long-term growth. Does the company invest consistently? And does that investment lead to valuable new products or services? Like Medtronic in the spinal market.
But isn't new product development really risky? Lots of failures.
Hugely risky. Most new products fail, so don't just take optimistic projections. Look for metrics like % of revenue from new products to gauge R&D effectiveness.
Okay. How about sizing the market? How big is the opportunity?
The 10K might give estimates of the total addressable market and the company's share. Immucor in blood testing is an example. Gives you a sense of the runway, but be critical of those estimates. Where do they come from?
Assess the potential pie and their current slice. What about the nuts and bolts? Do they have the infrastructure for growth?
Oh, crucial point. Growth needs support. Financial systems, operations, IT, people. Tillman Fertitta from Landry's warns about growing too fast, opening bad locations. Even Whole Foods was disciplined about new stores.
Can't outgrow your capabilities.
Exactly. Rapid growth without the foundation can cause chaos, quality problems.
Sustainable growth needs that solid base. Any other pitfalls with growth?
Yeah, a few big ones. Don't just extrapolate past growth forever. It always slows down eventually.
Yeah.
Don't overpay for growth. If it falters, the stock gets hammered.
Price matters.
Definitely. And watch for signs the core engine is slowing. Maybe they're suddenly chasing totally new customers or changing the business model drastically. And be careful with M&A growth. Understand the why. Be skeptical of synergy claims. The Cedar Fair Paramount Parks deal is a cautionary tale. Acquisitions need to fit strategically and be bought right.
M&A can destroy value easily. Okay, we've hit a lot of the qualitative stuff. Let's turn to the numbers financial health. Assessing operating and financial stability using the checklist.
All right, getting into the quantitative side. And a fundamental start. Do you actually understand how they make money? If it's too complex, too opaque, Like the AIG example, with complex derivatives, maybe walk away. Simplicity is good.
If you can't explain it, don't invest. Makes sense. What about international exposure?
Increasingly important. Need to assess those foreign markets. Is management committed? Are they adapting locally? What are the risks? Political, economy. Use resources like the World Bank's Doing Business Report, BMI country risk reports.
Okay.
And how do they manage currency risk? Hedging strategies like Lincoln Electric or LVMH. Use.
Global business adds complexity. What about operating leverage? How does that affect things?
Big impact on earnings volatility. High operating leverage means lots of fixed costs. Think airlines like Southwest Planes, staff. Sales go up, profits soar. Sales go down, profits plummet.
Sensitive to revenue changes?
Very. Low operating leverage means more variable costs, like a hotel franchisor, Choice Hotels. More stable earnings through cycles. Understanding that mix of fixed versus variable costs helps gauge earnings risk.
Got it. What about working capital management? Inventory, receivables.
Hugely important for cash flow. How fast do they turn inventory? Collect cash from customers, pay suppliers. A shorter cash conversion cycle, like Dell achieved, frees up cash.
Efficiency.
Yeah, need to track inventory levels, receivables growth relative to sales.
Yeah.
Also, distinguish between capital-intensive businesses needing lots of reinvestment in assets versus capital-light ones. And understand maintenance CapEx, the baseline spending needed just to keep things running. That's key for free cash flow.
Efficient use of capital. Are there specific financial red flags we should look for in the reports?
The checklist lists several. An unusually low tax rate compared to peers. Receivables growing way faster than sales. Are they stuffing the channel? Playing games with reserves. Cookie jar accounting.
Hiding profits for a rainy day or vice versa.
Could be. Look for consistent revenue recognition. Cash flow from operations should generally track net income. Are they capitalizing routine expenses, stretching out asset lives to lower depreciation? Lots of big restructuring charges. These can all be signs of manipulation.
Attempts to pretty up the numbers. What about the type of revenue? Predictability.
Recurring revenue is gold. Subscriptions, long-term contracts, predictable, stable earnings. Less risky, easier to value. Businesses relying on big, one-off deals are much lumpier, more volatile.
Stability is valuable. And recession resistance. How well do they handle downturns?
Good goal, but be careful. What seems resistant might not be. The Las Vegas example during the financial crisis is telling. Destination resorts got hammered, while regional casinos held up better. Understand the specific demand drivers.
Don't make assumptions.
And finally, debt. Understand the total debt, off-balance sheet stuff, coverage ratios, can they pay the interest? Maturity schedule, when is it due? A strong balance sheet provides flexibility, especially in tough times.
Too much debt sinks ships. Okay, last financial metric. ROIC. Return on invested capital. Why is this so important?
It's fundamental. How well does the business generate profit from the capital actually invested in it? High, consistent ROIC suggests good management, efficient operations.
Good returns on the money put in.
Right. But calculate it, carefully adjust for excess cash, maybe non-interest-bearing liabilities, get the return on capital truly used in the business, and crucially, a high ROIC is only great if they can reinvest future earnings at similar high rates. If there are no good reinvestment opportunities, that high return doesn't compound as effectively. Also, accounting differences can make comparisons tricky, and fast-growing companies might have temporarily lower ROIC due to big investments. Look at it in context.
High return and ability to reinvest. Okay. Huge amount of analysis. What about the investor's mindset? The sources touch on that too.
Yeah, the informed investor really stresses the long-term perspective. Avoid constantly checking prices, reacting to headlines, trading too much.
Tune out the noise.
Pretty much. Build a portfolio of good businesses you understand, bought at decent prices, and let compounding do its work over years, decades. Patience and discipline.
The long game. The checklist also mentioned a human intelligence network. What's that about?
It's about supplementing the public data. Once you've done your homework, talk to people. Customers, competitors, suppliers, former employees, headhunters.
Get the scuttlebutt, the real story.
Exactly. Build those contacts over time. They can provide insights you won't find in a report, especially when things get tricky or bad news hits.
On-the-ground intelligence. Lastly, the checklist warns about common errors in assessment. Cognitive biases.
Yep. Things like focusing too much on the easy-to-measure numbers and ignoring qualitative stuff like management integrity. Or not considering the specific context of a situation. And just being influenced by our own background and beliefs.
Our own blind spots.
We all have them. Need self-awareness. Try to actively counteract those biases. to make clearer judgments about businesses and managers.
Knowing yourself is part of the process. Okay, well, this has definitely been a deep dive. Let's just quickly recap the main themes.
Sure, we hit on generating ideas, but then the absolute need for research, understanding the customer deeply, assessing competitive advantages, the moat, and the industry landscape, pricing power.
Then that huge section on evaluating management from all angles: character, incentives, competence, capital allocation.
Right. Analyzing growth, is it profitable, sustainable, supported by infrastructure? Then diving into financial health, earnings, clarity, leverage, working capital, red flags, debt, ROIC.
And wrapping up with the long-term mindset, the human network idea, and being aware of our own biases.
Exactly. All pulled from the materials you gave us, a framework for asking the right questions.
Definitely a valuable distillation. Provides a really solid structure for thinking about business analysis.
Hopefully, yeah. Gives you a good lens to go back to your sources, dig deeper into areas that sparked your interest.
Absolutely. And on that note, maybe a final thought for everyone listening. Reflecting on all this, what's one specific aspect of analysis, maybe management, maybe the moat, maybe financials, that you'll consciously focus on sharpening in your next research project? Something to chew on. Thanks for joining us on the deep dive.